Welcome back to the show this morning at 6:33. Michael Lebowitz joining me as well. Talking a little bit about the Federal Reserve. So Mike wrote an article yesterday. It's on our website now. It's called the Fed's Monetary Animal House. And, it's kind of an interesting concept because it actually kind of, it's fitting if you ever saw the movie Animal House, about some of the antics that went on. I mean, we haven't cut a horse in half yet, but we're pretty much cut the economy in half in terms of those the haves and the have-nots. So it's not too far away. But Mike wanted to talk a little bit about a particular quote that the Fed had said back when Bernanke was in office. And I'm sorry, not Bernanke. I apologize. Something Jerome Powell said earlier when he came into office, and it's relevant today. So Mike, go ahead.
Yeah, so go back to 2012. Bernanke was actually head of the chair of the Federal Reserve, and Powell was just on the committee. And in the 2012 meeting, he made what I thought was a great statement, very truthful. And I thought it's worth reading because if it applied then, it's the amount of monetary policy has increased drastically. So let's think about what he said then and then apply it to today. So, and this is all quote from Powell in October of 2012. I think we are actually at a point of encouraging risk taking, and that should give us pause. Investors really do understand now that we will be there to prevent serious losses. It is not that it is easy for them to make money, but they have every incentive to take more risk, and they are doing so. Meanwhile, we look like we are blowing a fixed income duration bubble right across the credit spectrum that will result in big losses when rates come up down the road. You can almost say that is our strategy. This was in 2012 during probably QE2? Probably before QE3. And just for reference, just over the last 6 months under the Powell regime, he has done as much QE as was done during QE1, which was during the heart of a major crisis, and QE2 and QE3.
Combined.
Lowered interest rates to zero almost immediately. And as we heard from two questions in a press conference and numerous articles and plenty of anecdotal evidence, there is clearly risk is being taken at levels that remind me of 1999, where basically bankrupt type companies, whether they are bankrupt or not, are just shooting to the moon. Right. And if you look at his quote, he knows it. He knows it, and that's what they're encouraging.
Well, but two things here. We talked about this on the show when Jerome Powell was first, nominated as Fed chair. Everybody was very hopeful. It's like, oh, Jerome Powell, he's a different breed, and he's going to be different. I mean, he's not going to do what Janet Yellen did and Ben Bernanke did. He understands the risk of monetary policy, and he's going to be a different guy. He's a different stripe in terms of Fed chairman. This guy's going to be awesome. And of course, we had Danielle DiMartino Booth on our show. She said the same thing. And this was all of our hopes. I'm not saying she was right or wrong. I'm saying we were, everybody in the community was all hopeful that finally we were going to get a Federal Reserve chairman that was of a different breed, somebody who understood monetary policy, the risk that they would create, and the extraction of wealth from the middle class, and that maybe they would take a different tack. Unfortunately, he turned out to be exactly like everybody else. And I think it comes from this, it's easy to sit in the back of the room and make a statement, when somebody else is in charge. But when you're in charge and you've got the president breathing down your neck saying, look, if you don't start pumping up the stock market, I'm going to fire you. All of a sudden, when your job's on the line, so to speak, you say, okay, fine. What do I care if I blow a bubble in the stock market? As long as I got my job, I'm good. And we saw that evolution of Jerome Powell from this guy that was going to be of a different stripe to being the same old, animal we've always had. Right.
Maybe power just breeds corruption. Mm-hmm. And it's not corruption, but I think Powell has been, and this is before the crisis. This goes back to what he did, stopping the taper and all that stuff. The pressure got to him. And there's this need, this urge by Congress, by the president to do something, do anything. You got to do something today. And we get it. Look, the Fed needs to help out in a time of crisis like what we are going through and what we've been through, right? But there is zero recognition of what they are doing, what the future consequences are. And look, everything has a cost, right? What are those costs? It would have been nice if they would have defined all this after QE 1, 2, and 3. Here's the cost. We're going to reverse now this stuff, and it's going to hurt. But instead of wondering about the costs and considering the costs, they just go ahead and shoot their bazookas and say, we'll deal with that cost tomorrow. The problem with that approach is that that's what they did in 2008. And here we are later where the economy has grown at 2% a year for 10 years. Wages are barely keeping up. Wages aren't keeping up with inflation. And we have society that's rioting because the wealth gap has expanded further.
Yeah. I had an interview just recently with Pedro da Costa on our podcast, which is on our website now. If you go to realinvestmentadvice.com and click on our podcast channel and our YouTube channel, you can find our recent interview with Pedro da Costa. But he and I actually talked about this exact same issue. And we were talking about, the Fed relies on forward guidance, right? That's one of their big policy tools. And we saw this actually during the depths of the crisis in March, where they said, hey, we're going to buy corporate bond ETFs and we're going to buy junk bond ETFs. And all of a sudden, the credit market started to heal itself on expectations that they would ultimately do this. They didn't actually have to do anything. Just the forward guidance that they might do something would do that. So the forward guidance is a very powerful tool that they have to manipulate markets, so to speak. And maybe manipulation is the wrong word, but it's an accurate description of what they can do, because they can say one thing and they can get the markets to respond. If I was Jerome Powell and if I was concerned about market valuations, I would have, in the Fed presser yesterday, I would have said, look, as chairman of the Federal Reserve, my job is to maintain price stability and work on full employment. That's our mandate. That's what we're focused on. So we're going to provide liquidity in areas that we think will be the most beneficial. So, the PPP program, the Main Street Lending Program, those are areas where we can work to create better economic stability going forward. I want to be very clear as Fed chairman that I am not interested in supporting the stock market, and I would advise you that as soon as we see a recovery in the economy, we will be pulling off our liquidity, starting to normalize monetary policy. So I would, if I was an investor, if I was you, I would be in managing my investments accordingly. And the point about that is saying use the forward guidance to start bringing down the market slowly to get it more in line so you can begin to extract monetary policy without creating another 2018 type crash or a March crash.
Right. And I think all you're saying, Lance, and it's perfectly logical, is here's what's going to happen in the future. We put out this large sum of money. We're going to take it back or part of it back. So when you're buying assets, think about future cash flows. Don't think about what the Fed's doing. Think about what you're actually buying. Just like when you buy a house or you buy any asset. Think about what you're buying. Don't think about how we're going to support that price in the future.
Right, because we're not. We're eventually not going to be here anymore.
But they can't. But that's the problem. They've laid a trap for themselves. They're in a hole, and instead of trying to climb their way out of the hole, what do? They keep digging. Yeah. They are now twice as far. They're getting close to China now. They're digging so far deep.
You keep digging, eventually you get to the other side. Right. But yeah, I mean that's absolutely right, and that is the problem. And one of the things that I think investors need to be very aware of is that there is going to come a point in time. Now I don't know where that point is, right? I'm not saying that I know that the exact precise point today, but there is going to be a point to where Fed liquidity no longer operates. And what I mean by that is that at some point, valuations and cash flows and corporate profitability and earnings are going to matter, and they're going to matter whether or not the Fed is providing liquidity. And the problem for the Fed is they've now injected so much liquidity, they've got to keep adding more and more and more liquidity, and they're getting less and less effect for increased levels of liquidity issues. So, it's going to be a risk that the Fed runs into, is that eventually monetary policy, and we take a look at Japan as a good example of this, monetary policy may not solve the problems going forward. We'll come back after the break, pick up with Michael Lebowitz, CFA, wrap up the show, talk a little bit about some of these high flyers as well. Investors and on Robinhood and other kind of online trading platforms and free commissions have had a very interesting effect on the markets and where money is moving. We'll talk about that when we come back after the break.
Got questions for Lance later? Ask now at realinvestmentadvice.com.